I'm Mark Reefer, and welcome to the Wise Wealth Market Commentary, where in 5 minutes I give you our latest market insights. Trading was choppy to start the year, but as I record this on the last trading day of the month, the stock market, as measured by the S&P 500 index, is up about 3%, making it 11 positive months out of the past 13. Indeed, we have been spoiled. So can the market make it 3 positive years in a row? History says it may be tough. Today I'll explain the problem, perspective, and the prognosis as we head into 2025. First, the problem. The market is not cheap, and we need continued growth catalysts for another good year. Let's focus on the heartbeat of the stock market, which is corporate earnings. Wall Street analysts are expecting year-over-year earnings growth rates over 13% for the first and second quarters of 2025. But the S&P is already trading at a whopping 25 times prior year earnings, which is the highest valuation for the second year of a bull market since World War II. So corporate earnings will have to stay robust, or stocks will decline simply because much of the good news is already priced in. And unfortunately, that has typically happened in the third year of bull markets. The average return in the third year of the 11 past bull markets since 1947 was a mere 2% return, according to Stovall Research. What's more, all of those bull markets experienced a decline of 5% in the next 12 months, while 5 endured sell-offs between 10 and 20%, and even 3 of them saw declines over 3%. So that sounds pretty daunting. So there must be some other perspectives that can help our confidence this year. There are 2 that really stand out to me. First is the first year of the presidential term is historically positive in the financial markets. Since 1928, the stock market has posted gains almost 60% of the time in the first year of a presidential cycle. And it's on a hot streak because the S&P has produced positive returns in the first year of a new president 9 of the past 10 times. Well, the second indicator that helps me is positive as a perspective is the stock market Almanac's adage that says, as January goes, so goes the market. Rising stock prices in January have been followed by up years for the market nearly 84% of the time since 1950. And in years after presidential elections, the indicator has worked nearly 80% of the time. So that's certainly helpful information, but I'm more inspired by our prognosis for the economy. 3 good signs really to me: policy, rates, and resiliency. First, policy. The markets like Trump's pro-business policies, and we think that will continue. So far, the policies target energy, immigration, technology, and tariffs, and the goals are to reduce government bureaucracy, increase American oil and gas production, and boost American competitiveness via tariffs. And by the way, we do think the tariffs will likely be more of a negotiating tactic than a problem for the U.S. economy. And according to Crossmark Global, they expect President Trump's economic plan will result in rising business and consumer confidence, the extension of the tax cuts, and deregulation and some potential government efficiencies. Furthermore, Treasury Secretary Scott Bessent is proposing a 3-3-3 goal for the economy, which means boosting the growth annually to 3%, cutting the deficit to 3% of gross domestic product, down from 6.9%, and increasing oil production by 3 million barrels per day. Bessent has also asserted that the deficit problem is a spending problem, not a tax problem, and we happen to agree with that assessment. So the second good sign in our prognosis would be rates, and by that I mean interest rates. The investment climate can remain favorable this year because the market loves a Goldilocks economy that is neither too hot nor too cold, where the Federal Reserve does not have to raise interest rates. If inflation declines, the Fed will be our friend, and that's good for stocks. And just this week, the Federal Reserve left rates unchanged, and they're forecasting 1 to 2 cuts this year. And if that happens, that will be positive for the financial markets. Third good sign in our prognosis, and that's resiliency. We continue to see positive guidance from many companies. Ongoing reports since November have confirmed that the growth in artificial intelligence is not about to slow anytime soon. And since 70% of our economy is consumer-driven, we were encouraged by strong outlooks from Amazon, TJ Maxx, Costco, and Walmart in particular. And even though we don't expect the explosive growth in corporate earnings like we saw in 24, we're hearing of stable growth across several key sectors in the economy. So in summary, Although the market is expensive, we don't think the odds favor a big sell-off because the investment climate remains favorable, and we think the markets can stay resilient with moderately lower interest rates and taxes. Well, thanks again for watching, and as always, for your patience, your confidence, and your trust, and we'll see you next time on the Wise Wealth Market Commentary.